Hey, good morning. This is Mir Valensky with Driving Markets. I hope you're well. Okay, so again, the market is split into two. You've got two factors that is. Number one, you have the geopolitical issue, which Russia crazily is starting war with Ukraine, and it doesn't look like it's going to finish there. Russia is mainly driving the Ukrainian issue because, in my opinion, they're looking for the gas line and they're looking for the energy supply route because they know that Ukraine has got full of natural gas and energy resources, and Russia wants to secure that pipeline through to the West. By securing that pipeline, they then will have a stranglehold on the West and be able to dictate to the West exactly what's going on regarding their economic stance and regarding their position within the world. Furthermore, on the other issue, you've got the interest rate and inflation issue. Now, that's taken a bit of a back burner in terms of investor attention because the geopolitical one is the one that's driving the market, and that's what's looking at having the biggest impact short term on the markets. Be aware that when war breaks out, up until war breaks out, the markets are very, very nervous, and therefore the unsure, the lack of certainty drives the market volatility up to all-time highs, and that's what's happened recently, where you've got a uncertainty. Is there going to be a war? Is it just a small conflagration or a small dispute, or is it going to blow into full-blown all-out war between Ukraine, Russia, and maybe expand with some NATO input? If that was to happen, that would be the first World War since 1945. I don't think we're going to go there. I think all forces will pull back eventually. However, it does have an impact. So things to look at on the geopolitical and the impact of pending war is as follows. Volatility will increase up until there's an absolute war, and then generally when war breaks out, markets bounce and they come back and they tend to take a more stable route. So you could look at less volatility if war was to break out, which is a bit of a strange characteristic. Furthermore, what you should look at is soft grains like wheat, barley and rice. I mentioned this yesterday, that if war was to break out and Russia does disrupt the supply chain, then that will have a major impact on the basic foods that you and I eat on our morning, lunchtime and dinner tables, and all the grains. So therefore, look at the grains and look at the soft commodities as a potential of a significant price rise, and you may want to go long on call options on that particular commodity style. Looking at a correction, the moment we are in correction territory, so of the 20 most traded stocks or the most held stocks by investors, 3 of them stand out as particularly risky. Those were, and they're held by, these are part of the top 20 most held stocks. They are Facebook, which is quoted as Meta, Boeing, and Netflix. Each of them have their own individual problems, whether it's supply chain, whether it's design and direction, or whether it's interest bearing or interest related. So those are the stocks that are likely to suffer the most when markets take a correction, because each of those companies have their specific internal problems. So when you add the internal problems to those particular 3 companies and add in all of the economic factors and add in the geopolitical factors, then you could see, for example, those particular stocks, Boeing, Netflix and Facebook, which is Meta, quoted on the NASDAQ, as taking a further dive. I mean, Facebook at the moment is running around about the $200 level, and it's come all the way down. It's had a significant crash since we reported abominable figures and poor direction, and the market just doesn't like them. I've been saying actually recently, before the geopolitical crisis took off, that Facebook may look like an interesting buy about the 180 level, but taking in consideration interest rates and inflation, I might withdraw that and say, you know what, in my opinion, I think it looks more like a sell, because there is a head and shoulders appearing on the S&P, and the head and shoulders would indicate that the markets are going to go down further. We're just building a head and shoulders, so it's not absolutely certain yet. Again, anything could happen. These are all my opinions, and the markets could turn around very, very quickly. So taking a brief summary look at what's likely to happen is the tension is likely to increase further between Russia and Ukraine over the next few days. Market volatility is likely to increase over the next few days. The ups and the downs are wild, and it's practically impossible to trade. So when you're trading, please be very, very careful on that. Regarding Retail traders, always be careful. Institutional traders are always looking to place block trades and looking to get a turn on the actual trade itself. I see the dollar strengthening with rising interest rates. I see the pound strengthening. My view is that it's cable, and generally the pound is going to strengthen over the next 4 to 6 weeks. So I'm a buyer of the pound, and I would suggest that the euro also is looking particularly weak unless there is interest rates within the ECB. If you need to contact me on LinkedIn. You can contact me on WhatsApp, send me messages. I'd be more than happy to help. This is Meir Velensky with Driving Markets. Have a good day.